Let's talk about extended rate locks. So first and foremost, let's establish what a normal kind of air quotes normal interest rate lock is when you're getting a home loan. Normal rates, like when you kind of hear somebody say something or see something on TV, they typically mean it's a 30-day lock, meaning you lock the rate and you better have that loan closed and funded before the lock expires 30 days later. That's kind of normal. Locked periods for most companies will be in like 15-day intervals. Some companies can change, a few days here and there, but for the most part, the industry is going to say 15-day lock, 30-day lock, 45, 60. And I know you guys can count, but at some point you get up to about the 100 and, the 60 to 75. A lot of times it can jump, then 90 at 120. That's typically where a lot of times lenders will cut off to where you can do a 4-month lock and be okay and not to do anything out of the ordinary. So whether it's 90 days, 120, those are typically, like I said, the 90 days is pretty common. 120 depends on the lender, depends on what's going on. But you can go that far out and not to do anything too super out of the ordinary. Just know that the farther you lock, meaning the farther into the future it goes, the higher the cost. Whether it means a higher rate or more closing costs, is going to mean one of the two, because you're getting this guaranteed today saying, here's my rate with the great unknown of the future. So the lender is assuming some risk, which is why the rate goes up and up and up the farther out you go. So keep that in mind, but that's kind of how the normal locks work. So here we're going to talk about extended rate locks. So extended rate locks, they're basically just, all that means is longer, right? It means 4 months or longer. And so when you do extended rate locks, this can vary. And even us, like this is truly, we've had this page for a long time, many years, and we're kind of updating it just to, be current with the times. The reality is you're locking something for as maybe as little as 4 months or as long as 12. So why would you do this? Well, if you're in an interest rate environment where the rates are really, really good, like we crushed it during COVID when rates were at 3%, 4%, and somebody's building a home that could take 8 to 9 to 12 months, this was a no-brainer, right? Rates were so good, so low that these extended locks were absolutely worth doing. In most cases, you are going to have to pay some money up front, right? A deposit, if you will, because when a lender locks an interest rate, even a normal interest rate, but especially the extended locks, they are incurring a cost. And so on a normal transaction that's closed in 30, 60 days, they don't mind doing that because there's going to be revenue that follows with a pretty quick time period. For these, they're going to charge you money up front to help cover some of that cost. They're not charging you all of it, but they're going to charge you some. So whether it's a half point or a full point, it just depends on how far out you go. But just know they are charging that upfront cost for two reasons. One, to help cover theirs, and two, to put a little teeth in this because they don't want you walking away and sticking them with the whole bill, so to speak. They do want that revenue to show up. So these locks are typically there for most of the time new construction. I don't know that you would see a whole lot beyond that. Like if you really needed or wanted something for like a construction loan or something like a rehab, you could do it. But for the most part, it's going to be that piece. And so what happens is on these extended locks, they're going to say, hey, here's like a cap, meaning like, hey, the rate's going to be this today. If today's rate is X and you're going to lock it for 9 months, they're going to say, cool, add this amount to today's rate. And that's going to be like your new locked rate at worst case, meaning they're going to give you that extended lock for 9 months at whatever that premium is, today's rate plus that premium. And they're going to go out and say, here's how much that cost. In terms of like upfront money, whatever. But if rates 9 months from now are lower, let's just say we didn't need it. The nice part is in most examples, you're going to be able to take the lower rate because that initial locked rate was just kind of the ceiling or the max or the cap. It kind of puts a limit on the damage that happens with market movements in the future. So again, I go back to the COVID example and rates were at 3 and people were locking at, let's say 3.75. When rates hit 5% really quick, they were so super happy. And we were happy for them. That's wonderful. But early part of COVID, when we didn't know how long it would last, locked the rate at 3 and then the 3.75 when you did the 9-month lock. 9 months later, rates were still pretty good, still in those threes. So they ended up not using the 3.75 and they got the free float down to whatever the current market would have been at that time. So again, These extended locks, I would say sometimes they can go down to 3 months, all the way to 12. A lot of times you'll see between 4 and 12. A lot of times it can be, maybe it's 4, 6, 9, and 12. Some programs will do it every month. You can get 4, 5, 6, 7, 8, 9, 10, 11, 12. So it just varies based on the market and all that stuff. I'd say at the time of this taping, these are not something we're selling or pushing or doing, because at this moment, the rate cycle is such that we do think rates can and will be going down in the very near future. So understand that is a thing. When you do these extended locks too, something to keep note of is that, a lot of times you cannot extend these beyond the initial lock term. If you can, maybe it's for 30 days. It'll get expensive. Maybe it's 60, depending on how nice, the lender wants to be. And I say that meaning like just depends on the market. They don't just pick this, because you're a good person. The other part is, if you want to extend it, maybe it has to be an underwriting. Closing date has to be a firm closing date. A couple other things is the property address. You cannot change it. Like once you have an address, you have to stick it to that property. So if you decide to bail on that house and go buy something, you can't switch your lock over. So those are just some of the nuances. Beyond that, I think that's kind of the highlights. And again, the biggest thing I would say is just make sure you're talking to us about it, whether it's, something you're thinking about or already done. I would just look for making sure that all the information is known. We can talk through it, because again, these are something that can change based on the market, the environment, the lending state of things. So reach out to us if you have any questions. And whether you're building new construction or otherwise, at least let's have that conversation about where we think rates are going based on when you think you're going to close. As always, when you think mortgage, think Martin.